Here it is, right on the screen this morning, Dow 21,000, we go there. Does that change things for you in any way, shape or form?
No, not in the slightest. I mean, I think the Dow's the wrong type of index just because of how it's calculated. The S&P for me is much more the...
Oh, you're a Dow truther.
Well, I just feel it gets manipulated by, the size of the companies and the share prices rather than giving you real insight into what's going on in the economy, or in corporates, which is where the S&P, I think, is more reliable.
But that headline will be on the front page of the newspaper tomorrow.
Yes.
Does that make a difference?
Well, I think for a lot of people who are buying this market, I know there's a lot of US retail now moving into this market. It will make them feel happy and validate it. But I think you have to look, as we've discussed before, you just have to look underneath it to go, what are the investment opportunities? What risks am I running? And I think we are now into what we would all agree is implementation risks. We have the what can Congress and Trump get done and how long does that take? What is the sequencing of those events? And the other side of it is we now have the implementation risk of the Fed and raising rates. I think up until 2 weeks ago, almost everyone was expecting rate rises in Q4 this year, not in March. I think the sooner these things start calibrating, the more we will see the real underlying credibility of the market.
David Weston's been asking about the earnings time and time again. Every time the quarter comes around, they're going to improve, they're going to improve. At 15, 16 times forward earnings on the Dow, historically, that is not huge. My question to you then would be, if we are experiencing irrational exuberance, is it amongst the analysts that think we're going to see the earnings recovery? Are they seeing things too rosy than maybe they're otherwise going to be?
Well, I suppose one thing is I would take half the earnings growth out because it's all share buybacks. But that is going to accelerate before it finishes if we get the repatriation from particularly the tech and the healthcare industry, because they're the ones who own the cash overseas. But once you strip that out, I would argue the underlying S&P earnings growth is pretty much what the US economy is growing at, in which case, why are you paying 15, 16 times earnings for 2 or 3% growth? It feels to me pretty expensive.
So much of the US economy is consumer driven.
Yeah.
And to go back to Jonathan's point about the front page of the newspaper, it's not just people buying in the market. It's your average person out there feeling better about their pocketbook, whether rationally or irrationally. Can animal spirits help drive this market?
Well, and yes, but I think they have. And I think when you look at, interestingly, in the last 6-9 months post-Brexit, the US consumer and the UK consumer have done the same thing. They have borrowed, generally to buy cars, and they've drawn down on their savings to keep their lifestyles going. To your point earlier in the headlines, that real wages are being crimped by inflation at the moment and will probably continue to be so. That is unsustainable. We know the US hasn't saved enough for its pensions in general, and we know the US has generally borrowed quite a lot. So,
I mean, you're making a really fair bear case as we hit Dow 21,000. What's the risk, though, of you got retail was already in the market, right? You get active managers coming in the market. If you get some kind of equity capitulation and the movement going in out of bonds into stocks, do you miss out on that rally? How do you hedge that kind of risk?
Well, I think the thing is, as I said, we're looking globally, but I think from a US investor, I would say I like the equity rally, I like the reflation story that if the US gets going, the rest of the world will continue to get going. But maybe the value is not in the US equity market or in parts of the US equity market. So you play what the
US is reflecting, but not in the US at the end of the day.
Yes.
And ultimately, you think the equity market has to re-rate if you truly believe the reflation story and re-rate lower.
Yes. Well, as I said, history shows when the Fed raises, and the Fed will raise, the more they get clarity on Trump and the traction of his policies, the more they will feel competent to raise rates. And they won't take the call from the White House. They will raise rates. They always have, and they kill a lot of the runs in the market. The equity market will derate during a period of rising rates.